Hello, Bankers. Welcome to Learning Sessions. I'm Himanshi Malik, and today we are going to discuss Chapter 24 on AFM. So, before we start with Chapter 24, that is on capital structure and cost of capital, just one thing I need you to remember that this topic is more of a practical topic. So, you need to understand the concept of finance that I will explain in this lecture rather than just focusing on what is written on the notes, because what's written on the notes is going to help you in revising this chapter, but in order to understand you have to attend the lecture fully till end. Only then you will be able to understand, because see, all the topics are going to be interlinked. The first thing I'm going to teach is going to be base for the another thing, so you cannot miss on anything. So a huge request to all of you that do attend the lecture complete if you're going to watch this lecture. And just like this, all the concepts in especially financial management are going to be interlinked. So one thing you want to ensure is you study in sequence, in the sequence that we are teaching you on your course. So to access all the videos on this, all the lecture on AFM, you can download Learning Session IBF exam app. It is available on Android and iOS both, and from there you can get the access to all AFM lectures. So why it is important? So you can, watch the lectures in sequence and don't miss out on any concept. Because if it was a theory concept, you can just start from anywhere. But especially in financial management concept, everything is going to be interlinked. Maybe the topic, maybe the concept we discussed in the first chapter going to be base of every question we start or every topic we start. So you will have to know that simple small base, only then you can understand this. So that was one small request to all of you, so that you can study in a proper manner. Now let us start our chapter on capital structure and cost of capital. I will start this lecture by asking you all a question. And that question is, just imagine that tomorrow you're going to start a business. Now, where are you going to get the funds to start your business from? I want to start a business for which I will need 1 crore rupees tomorrow. Okay, if I'm going to start this business, how am I going to arrange the funds? What are the possible sources? Let's count our sources, okay? Number one is I will put my own money, self money, right? Number two, I will ask for help from friends, family, my colleagues, maybe they want to help me, right? Or what else can I do? I can get somebody to invest in my business and ask them, okay, I'm starting a business. I need 1 crore rupees. Would you like to put in some money so we can start it together? You can get return, right? We can ask someone to invest. What else can we do? We can go to the bank or any private financing institution and we can ask for loan for starting the business. These are the possible sources from which we are going to get money, right? And all these sources are what? These are your sources of capital. Because let's understand what is capital in the business. Business is run by money. We need money to run business. We run business to earn money, right? How am I going to get money is the question that we are always going to solve in financial management. And what is capital? Capital is nothing but the funds we put into our business that are going to be used for long term. Simple. The funds we put into business that are going to be used for a long term are capital funds. Clear? So, what are the sources of capital? Based on these answers, I can safely say that the sources of capital are nothing but just two sources. One is investing my own capital, my own money, and the other one is taking debt from somebody, right? See, if I put money by myself, what is it? It is my capital. If I ask friends or family to help, this is what I'm taking debt. If I ask somebody to invest, I will have to give them share in my company, give them share in the profit. This is what? This is capital investment, right? And if I'm going to bank, I'm taking a loan to start my business. This source is debt. So all the sources of capital fall under these two categories only. One is your equity capital, your own capital, and the other one is your debt capital, that the money that you're going to repay to whoever you borrowed it from. Are we clear on that? That whenever we are going to start a business, we need capital. And there are only two sources to get capital. First is equity and other is debt. I guess we are clear on that base. And since we are in the finance field, we all somehow knew this, but it was important for us to brush up on that concept. Now, the chapter we are discussing here is capital structure and cost of capital. What do we mean by capital structure and what do we mean by cost of capital? I just told you now that we have two sources of capital mainly. First one being equity and the other one being debt. Right? The manner in which I'm going to put these two sources in use will define my capital structure. What is the capital structure? It is nothing but the ratio in which we are using equity and debt. Let's see this example that we have in our notes. A firm started business raising total long-term fund. Long-term fund means capital. So they needed 500 lakh of capital to meet their requirement. And how did they meet this requirement? They put 200 lakh as equity capital and 300 lakh as their debt capital. So in this case, how we are going to structure our capital? We are using 200 lakh of equity, 300 lakh of debt. It means my capital ratio is nothing but 2 is to 3. So from this, I hope you can get a basic idea. When I say capital structure, I'm saying equity versus the ratio of equity to debt in the business. Understood? So this is what we mean by capital. Then the next topic that we're going to cover in this chapter is cost of capital. Any time we put funds into business, it does not come for free. If somebody is giving us their money, even if we are putting our own money into a business, we expect something in return. We have to get something in return, only then we are putting the money, right? So the return that is to be given to people who are putting their capital into our business is cost of capital to the business, right? We have to understand from two aspects. The first aspect is of the business and the other aspect is of the person who is investing. The person who is investing the funds is expecting a return. For them, it is required rate of return on their investment. And we did discuss this topic a little in the previous chapters, right? So, if I'm investing money in a business, I expect something in return, and that is nothing but my required rate of return. But from the point of view of business, in which this person is investing money, this required rate of return is what? This is my obligation. I am taking money from you. You expect me to give this amount of return to you, then that is what? That's my obligation. It means it is my cost of using these funds, right? Each capital source has its own cost. For example, if I take loan is which source? It is debt capital, right? So when I take loan, the interest I pay, what is this interest? This is my cost of debt capital. If I'm taking equity, if I issued equity shares, then I'm giving dividend to the shareholders. What is that dividend? That dividend is my cost of equity capital. So these are the two topics that we are going to discuss. That what is capital structure, how do we decide the capital structure, and the other one is what is cost of capital. First, how we calculate different cost of capital, what are the different methods of calculating cost of capital for business, and how are we going to balance our cost of capital. That is the whole purpose of this chapter. So we are clear with the base and what we are studying and why we are studying it, right? So whenever we study debt, automatically one topic comes with it, that is leverage or gearing. So for this, I'm going to give you some example. Look, if we take the example of a car, okay, a car versus a bicycle. Now what happens? In a bicycle, you're running a bicycle. What is the speed going to be? The speed of the pedals, right? How fast you're pedaling is going to be the speed of the bicycle. It is simple as that. You cannot increase that speed. The effort of your pedal is equal to the speed of the bicycle. But in a car, can we increase the speed? Yes, we can. In the first gear, we are at a slow speed. Then we put to second gear, we're a little faster. Third gear, fourth gear. So each time we change the gear of the car, the speed increases. But do we change our effort? We have to put the same thing. We have to put same pressure on the pedal, but the speed is going to increase multifold just because we used gear, right? That is one example. Another example in real life is when we have to change stepney of a car, what do? Can we lift the car with our own hands and change the tire? Answer is no. The car is too heavy for us to carry. But when we use lever, right, then we can lift the car without putting much of effort, and we can change the tire easily. So what am I trying to explain here? That sometimes our manual efforts do not get us higher returns, right? If I keep pedaling manually, I may not be able to get 100 km/h on a bicycle, but I can so easily do that on a car if I change the gear. And simply, I cannot lift the car to change the tire, but if I use lever, I can easily lift that car up. So, manual effort may not always get us high returns. So, to increase our return, what we do, we use some kind of leverage, right? And that leverage help us get higher return, higher result with the same effort. Similar concept is used in financial management. What is this concept? Now let's understand. I am a person investing in a company, ABC Limited. Okay, so what did I do? I invested 100 lakh rupees in this company, and I'll run the business for 1 year. It made 20 lakh in profit, and my return on capital is 20%. So I'm happy that I invested 100 lakh rupees, I'm getting 20% return. Now that is simple. But what if I want more return? What if I want my return to be 25, not 20, I want it to be 30? Can I do that by just investing 100 lakh? Answer is no. I need to invest more, because there is a limit to which business can give return on a certain amount of money, right? So if I'm investing 100 lakh, I can only get 20% in return. But is there a way to increase this return without increasing this capital? Similar to how we increased our speed in car without increasing our effort. So we actually can do that in business, and that leverage in business available to us, like in car, in real life we have gear in the car. In business we have the gear called debt capital. So this debt capital is going to help us increase our return without actually increasing our capital. Now you would think that how can debt possibly increase our capital? If we are using debt, then our interest cost is increasing. If the cost is increasing, then how can we say that we will get more profit? The answer is we actually do get more profit. Let me explain how. Now, let's take the same example of ABC Limited. ABC Limited only needs 100 lakh. It does not need more than that. Now, this time, instead of putting all 100 lakh by myself, what I did, I chose two capital sources, one being equity, the other being debt. So, I took 50 lakh from equity capital and I took 50 lakh from debt capital at 10% interest. Okay. And the company at the end of the year made same profit 20 lakh. So this 20 lakh is earning before interest and tax. Okay. So before interest or tax, the company made the same profit of 20 lakh. In previous scenario, this 20 lakh was my net return. But in this case, I have taken debt capital also, so I have to pay interest. So I will subtract the interest from here. 50 lakh into 10%, that is 5 lakh per annum. So I paid 5 lakh of interest, and my profit after interest is, my earning after interest is, earning before tax will be 15 lakh. Now for simplicity, we are not going to include taxes for now. Let's just assume that this 15 lakh is my final return. So what is my return on equity that I invested? This is the owner's profit, right? This whole profit goes to owners. So the investment I did was 50 lakh and the return I got is 15 lakh. 15 divided by 50 is 30% per annum. So can you see the difference? In previous example, I invested 100 lakh rupees all of my own and I only got 20% in return. Now I invested half of the amount I previously invested and my return has increased by 10%. But the overall capital I put into the business, that did not change. The profit that business made did not change. What changed? We used leverage, and that leverage was this debt. And that is how debt is going to help in increasing our capital. So I had 100 lakh rupees. Out of that, I invested 50 at 30% return. I can invest the other 50 at some other amount of return, and ultimately I can earn more on my investment. So that is the concept here in leverage. That leverage concept is clear now. Another concept important to understand here is the capital structure. In this example, we used equal capital structure, 1:1, right? We used 50 lakh equity, 50 lakh capital. But if we played a little more on debt and equity, let's say we used a little more debt, maybe our return would have been higher. But if we use too much debt, then maybe this return reduces. So that is why it becomes important to first use debt. Yes, that is going to increase your return, but it is also very important to see the capital structure properly, because if the capital structure gets shuffled too much, maybe that will reduce your return instead of increasing it. So that is why it is important to understand two concepts. The concepts are, first is of capital structure, that how we are going to use equity and capital, and the other one is cost of capital, because cost of capital is going to help us in determining our capital structure. So that is the introduction on debt, capital and leverage. Let's see what we have here in the notes. I hope you were able to understand this example. Now let's take the leverage meaning. So leverage, if the business is highly leveraged means we are using debt capital. We are using high debt capital. Then it will be a highly geared firm because we are using high gear, right? And if we are using lower debt capital, then we have low leverage or low geared firm. So we have taken basic understanding on the capital structure. How will the companies decide capital structure, or what are some of the factors that affect the capital structure? So the first one is norms prevailing in the financial system. Like if we go to bank and we ask them to finance our project, maybe bank has lending policy and norms that we will not invest more than 60% of the finance. So in that case, you automatically get your capital structure that you have to put minimum of 40% equity and you can get 60% of debt, right? In that case, the financial system will define your capital structure. Other thing is degree of control. So if the owner of the company, they put less of their equity, what will it mean? It will mean that their voting power or their control on the company might get reduced, right? So in that case, they want to maintain higher control. So they will say, okay, I will keep 60% equity at all cases. So in that case, the capital structure will be 60/40. Another thing is cost of debt. What this is one of the most important consideration. We have to ensure that the cost of debt is such that it is increasing our return instead of decreasing the return. So then we see how much debt is costing us, and then we can decide the capital structure on that basis. We will discuss this topic in further discuss this in detail in the further topics, how debt cost define the cost capital structure. Then another factor is size of firm and its business plan. So if a firm is, let's say, of very small size, they can simply use debt for expansion. But if the company is a very large company, for example, Reliance, right? So they want to use all their capital sources in a way that also ensure financial stability. So size of the firm, the expansion plan are also going to define your capital structure. These are some of the factors that define the capital structure. Got it? Next topic we have approaches on capital structuring. How we are going to structure our capital, how much debt to use and how much equity to use. And this topic is based on two core concept. First one is cost of debt, and the other one is cost of equity or cost of capital. From these two, we can calculate the overall capital cost, and then we can decide the structure we are going to follow is the one where we get minimum cost of capital. That is the whole concept here, but I will not be teaching you this concept first, because first I need you to have basic understanding on calculation of cost of debt and cost of equity. Then I will teach you how to calculate overall cost of capital. Okay, so we will do this topic at the end of this chapter. All these topics are related to capital structure, so we will discuss these later. Let's start with the concept of cost of capital, because we need to understand cost of capital calculation first, then we can understand overall cost of capital and capital structure. So what is cost of capital? Like I explained, that it is the cost of company's funds, both debt and equity. Every person who is putting money in business is going to expect something in return, the minimum return that they expect from the company. Like equity investors, they take more risk, then they will require more return, and debt capital require fixed return, right? They need fixed, whether the company, they don't care if the company earned profit or not, they need their fixed return. So the costs differ for both of them. So first we are going to discuss the cost of debt capital. So what can the cost of debt capital be? It is very simple. If I'm taking a loan from bank at 10% per annum interest, then this 10% is my cost of debt. So what are we going to learn to calculate in this? There are two concepts that you need to know. Like equity market, debt has also its own market. There are two type of debt. One is a debt that is not traded in the secondary market, simply the long term loans we take from bank. In that case, the cost of debt capital is the interest we are paying on that loan, right? For example, 10% per annum. But in some cases, like in case of if we are using bonds or debentures, now these are the debt instruments and they are traded in the secondary market also. In these case, we do pay a fixed coupon amount to them. That coupon amount is the interest we pay. That is a cost. Plus, in this case, the investor also have a expected rate of return because they see, okay, I'm investing this much, this is what I need. In their case, the return is not only based on the coupon, they also see, okay, how much I can get in the final return. So in this case, if there is a secondary market also, then cost of debt capital is a little different. So how do we calculate cost of debt capital when the instrument is also traded in a secondary market? So let's just see how we calculate it. So we are going to discuss the topic of cost of debt capital. Now pay proper attention to this topic, okay? Now, when we invest in debt, there are two things that we need to consider. One is the yearly return that we are getting. This yearly return is what? This is your coupon that you will be paid, coupon or interest, right? But in case of any instrument that is traded in the secondary market, we have two type of return. One is the return normally we get like interest or dividend. Other one is the appreciation of capital. For example, if I invested something at 100, when I repay it, I may get 110. So that 10 rupees is also my return. In case of debt, how it works? We invest in debt at, let's say I invested in a 100 face value bond and I purchased it for 90 rupees. Now, I invested 90 rupees in this, but when this bond will be redeemed mean, well, when the company will repay this its face value, it will give me 100 rupees for 1 unit of bond that I hold. It means for investing 90, I am getting 10 rupees in extra, right? This is also my return. So when we say debt capital, we calculate two costs in that. The first one is your normal return, the coupons that you get, and the other one is yield to maturity. Another important thing you need to understand is the return on a debt capital is called yield, how much we are getting in return. And yield to maturity is of two component. It contains two component. It includes your coupons plus the capital appreciation. Okay, so how this works? Yield to maturity, what does it means? If I'm investing in a bond today at zero period, it get invested in, it get redeemed in fourth year. So I have invested my money for this whole 4 years, and I need to see how much total return am I getting, not yearly return, total return on my investment. That is called your yield to maturity. Are we clear on these two core concepts? Because I'm going to give you more terminology on debt capital. So this is the total return on life of debt of debt instrument. Now let's take an example. We have a debt, we have a bond, and these are its terms. First of all, whenever a bond is issued, it has a face value that shows the amount the company will return to you when they will redeem this bond. That is the face value of the bond. Let's say it has a 100 rupees face value. The next thing on a bond is its market value. How much this bond is traded for in the stock, in the secondary market, in the debt market. So let's say it has market value of 90 rupees. And third one is your life. कि कितना time, how much is the period of this bond? So let's say we have this bond for 4 years, let's say. Then we have return. Return is the coupon we are paying. We are paying coupon of 10%. One important thing to understand, coupon is always paid on the face value. So these are the term of our bond instrument that we have. We have face value of 100, we have market value of 90, life of 4 years, and coupon of 10%. Now I need to calculate the yield to maturity on this bond. How is it calculated? So we have a formula for calculating yield to maturity, and that formula is, first of all, we take the coupon amount plus, we denote coupon by C. So I will write C here, okay? So you can learn the formula also. Coupon plus, but the second thing I told you was capital appreciation. So how we get capital appreciation? We take face value of bond is what we are going to get at the end, right? Face value minus the market value at which it is traded today. This is my capital appreciation. But this return is how is it? This return is given over a period of 4 years, and this coupon is given annually. So it means there is imbalance in the period of return. This coupon is per year and this return is for 4 years. So what I need to do, I need to make them equal. I will divide it by the life of the bond, that is T. Are you understanding the concept? Coupon return is for 1 year, but this capital appreciation was for the whole life of the bond. So we need to reduce it to 1 year so it matches with our coupon. Okay, that is done. The next step is divide this whole return. This is the return portion, that is your numerator. Then we write the denominator. Denominator will be your investment. So what should be the base of capital that on which we should calculate the return? Should it be the face value on which I am getting return? Should it be 100 or should it be 90 on which I'm get or what actually I'm investing? So the answer is I am getting return on both. The coupon that we are receiving on 100 rupees. We are getting 10% coupon of 10 rupees, right? And the capital appreciation I am getting because I invested only 90 rupees and I'm getting 100 rupees in return, the face value of the bond. Since both are the basis of my return, I will take both of these amount for calculating my return on capital. Okay, both these amount will be taken as base for capital. How will we take? We will take the average of these two. So face value plus market value and their average. So this is how I am going to calculate my yield to maturity. Are we clear on this? Let's recap quickly, okay? I will take simple example, then I will once again explain to you the formula, because I could very easily tell you, okay, this is the formula, this is how you're going to calculate YTM. But you're going to be banking professional. You should know, okay, why am I using this formula? What is the logic behind it? Because if you caught on the logic once, you will never in your life have to cram these formulas. You will be able to make them on your own because you know the logic. Okay. So it is important for me that I explain to you the whole concept, and I really hope that you sincerely watch this whole lecture, maybe watch it twice so you can get the whole grasp of the concept. So how this formula is made, let's just take a look once more. Whenever we are calculating return, what we do, let's say I invested 100 lakh rupees and I get 20 lakh in return. What did I do to calculate my return? 20 lakh is the return, 100 lakh is what I invested, and I say, okay, I invested 20%. This is how we calculate return in normal scenario. The numerator is your return, the denominator is your capital. This is the basic, this is the core concept that we are using in this YTM formula also. How the return I'm getting in debt capital is of two part. The return in my debt cap investment is of two component. The first one is the coupon interest and the second one is the capital appreciation. But since we are using this in the numerator, we need to ensure that both of them are of the same period. If the coupon I am taking is of 1 year, I have to make sure the capital appreciation is also of 1 year. So we simply divide it over the term of the bond so that we get 1 year of capital appreciation, and that is the total return on the debt we get. Simply coupon plus your face value minus market value divided by n. Then the denominator we used was the capital invested. So coupon return was on the face value and the capital appreciation was on your market value. So instead of taking one of these values, because both are to be considered, what we are doing, we are taking average of these two, so we can actually calculate what we are actually getting in return. Okay. So simply that is your formula for yield to maturity, that coupon plus face value minus market value divided by term of the bond, and in denominator face value plus market value divided by 2. This is how we calculate yield to maturity in case where our debt is also traded in the secondary market. If the debt is not traded, if debt is not traded in secondary market, so what is the scenario then? Then whatever the face value of loan is equal to market value of the loan, because the loan is not going to be treated in the market value, or we can say this market value is removed altogether, right? So the return will be calculated from this formula only. Now I don't have any market value, it means this portion will not be there. What will be my numerator? Simple coupon or the interest I'm paying. And the investment, since I don't have any market value, my investment will simply be the debt amount. So if I have taken a loan of 5 lakh at 10% per annum, my cost of debt is 50,000 interest paid on 5 lakh, and this is 10%. Are we clear? These are the two concepts on cost of debt capital. And one important thing you need to understand, YTM is the return on the overall period of the debt. Whenever we are using cost of debt, we use KD. In financial management, this is how we denote cost of debt. We use KD. Clear? Now let's use this formula to calculate cost of debt in our example. This was our example, right? Let me just erase all the extra things. Capital. So from this, we are going to calculate our return. What will be my coupon in this case? 100 rupees face value, 10% coupon rate. What will be the coupon amount? It will be 10 plus face value 100 minus market value of 90 divided by the period, that is 4 years. This is the total return numerator, and denominator we have face value plus market value and its average. So let's just calculate it. 10 plus 10 divided by 4 is 2.5. When then 190 divided 2 is 95, right? So what will be my YTM? It is 12.5 divided by 95. That comes out to be 13.16% approximately. That was your example on calculation of cost of debt. I need you all to write this down because this is something I have not given in the notes. Or even if I have given, you will not just note down all the terminology that I explained, right? So this is your concept of cost of debt. Now, let's move on. Let's just see what we have here. Cost of debt capital. I explained this topic to you. Then we have the formula. Here, the formula is a little off. Instead of using this denominator, use the simple one that I gave you. That is PV plus MV divided 2. This one is simpler to use. Okay, so the formula will be, let's just rewrite it here. You can also write it for your reference. C plus MV minus PV divided N, and PV plus MV divided 2. MV is your face value that we used, and PV is the present market value. You can use the any notation that you like. Okay. So this is the same example that we discussed. Next topic is cost of preference capital. So cost of preference, first of all, preference capital is similar to debt capital. How? Even though preference is considered a part of equity in legal terms, but it is equal to debt capital if we talk about financial terms. How? What do we call debt? We call such capital debt on which we have to pay the required return whether we make profit or not. If I have taken a loan, I have to pay interest to them. Even if I'm in loss, even if I don't have any money, I have to pay the interest. Similarly, in preference capital, whatever the dividend that is fixed, we have to pay them back anyhow. Even if we are not making any profit, we have to pay the dividend to the preference capital. So that is why this is also a fixed return bearing instrument. Whereas if we take equity capital, we only have to pay them dividend when we are making any profit. So that's why we say that the equity shareholders always take the highest risk, because they are only going to get return if the business is making any profit. So cost of preference capital is covered under the cost of debt capital only, because both are kind of similar in nature. Preference capital carries a fixed rate of return, also called dividend, like debenture, but has higher risk perception. Why its risk is a little higher than debt? Because when the company is paying money, how it works, first of all, if a company has done sales of 1 lakh and its cost was, let's say, after all the cost was 50,000, this is its operating profit. Then subtract all the things, uh, admin expenses or other expenses, let's say 10,000. This is the return available for use. Okay, this we call earning before interest and tax, EBIT. Out of this, what goes first? First, we are going to pay interest. Let's say I have 5,000 of interest. I have to pay interest, then I get 35,000 earning before tax. Then we pay tax on this. Let's say for simplicity, I'm taking 5,000 tax only. We get 30,000 in return. Then we have to, then this is called your earning after tax. Out of this amount, we pay preference dividend first. Let's say I had 10 lakh preference share at at 2% dividend. So 2% on 10 lakh comes out to be, if I'm not wrong, 20 lakh, 20,000. Yes, 20,000 preference dividend. Then the amount that is left, this is called earning for shareholders. And out of this earning, we pay dividend, whatever dividend we pay, and the remaining amount goes to retained earning of the company. This is how the whole financial balance sheet works, financial profit and loss works. So whenever a company has to repay, first preference is given to debt capital, second preference is given to preference capital, and last preference is given to equity. This sequence, this same sequence is followed whenever the company has to repay, even if it is the return or it is their capital amount. Preference is debt, preference capital, equity capital. That is why debt is the least risk bearing asset. After that, preference is also less riskier but a little higher than debt. Then we have equity, that is the highest risk bearing investment. Okay, so this is what they are trying to say here, that like debenture, it has fixed rate of interest but it carries higher risk because it comes after secured creditors in receiving money in case of liquidation. That is, after that we are going to pay to them. Now, as in case of debenture, the approximate cost of preference YTM can be calculated using the same formula, because preference share are also traded in the secondary market. So we can use the same formula that we used for calculation of YTM of debt. We can use that in calculation of preference capital. Okay. So this is the same formula. In this case, annual interest payment, instead of using annual interest payment, what we can say, we can use the word dividend, because the return on capital, preference capital, is dividend. And similarly, market value minus face value. Every share carries a face value divided by N, and M plus F divided by 2. This is the formula you can use to calculate YTM on preference shareholder. This is for the whole life of the debt. If we are going to calculate for 1 year, what formula we are going to use? Simply dividend divided by whatever market value you invested. This is your yearly return. I just explained to you that return are in two views. First is yearly return. The second is return for the whole investment period. Return for whole investment period is called YTM. For yearly return, it is called simple return on investment. Then last topic we have is cost of equity capital, one of the most important topics. So till now we have covered cost of debt, which we will denote as KD. We have covered cost of preference, that we denote as KP. Now we are getting cost of equity, that will be denoted as KE, cost of equity. So similar to debenture and preference, equity also gets two returns. What are the returns? First one is dividend, second one is capital appreciation. Right? And the investment in this case, because equity is always traded in the secondary market, then the investment that your base is going to be, that is the face value of, sorry, not face value. How we calculate equity cost? We calculate it by using market value of shares. Now you will have a question that in case of debt or preference, we had both face value and market value, but we didn't use market value only, we use face value plus market value and its average. Then why in equity we are using market value of share? So the logic is, when we are using debenture or preference capital, we as a company, we don't care what is the market value of that instrument. When we come to repayment, we will only repay the face value. Okay. In case of debt and preference, the repayment value is always the face value of instrument. But in case of equity, when the company has to redeem the equity capital, they cannot redeem it at face value. You will see in most of the cases, face value of share is only 10 rupees, 20 rupees, even 1 rupees. A company never repays equity at face value. Equity is always repaid at market value or higher. Okay. So whenever we are going to calculate cost of capital for company, we have to take the market value only. Understood? So that is why I'm going to take only one base here. So this is the base. So we know the calculation that return is calculated as dividend plus capital return divided by market value. But in case of debt or preference, we always had a fixed life of the instrument. That is for 10-year, 5-year, 1 year, 2 year, 3 year. We have a fixed life after which it will get redeemed. In case of preference also, we have redeemable preference share that get redeemed after a particular time period. But have you ever seen a case where company issues equity capital for a fixed period? Answer is no. Whenever equity is issued, we assume that the return will be perpetual. Till infinity, we will get the return. Then how can we calculate YTM in this case when we don't even know the period of return? So that is why we are going to use time value of money concept to calculate return on equity investment. Okay. So first of all, let's see this concept. Cost of equity is the percentage of return payable by the company to its equity shareholder on their holding. Methods used are capital asset pricing model, bond yield plus risk premium, dividend growth, or earning price. Because in this case, we don't have a fixed period, we have different model for calculating the cost of capital, and one by one we are going to see how cost of equity is calculated under different models. Okay. So first I have capital asset pricing model. Calculation of cost of equity. First method is capital asset pricing model. Okay. In this case, the cost will depend on three factors. The first one is risk-free rate of return plus beta of company's share price, and the third one is expected market return. Three terms we're using: risk-free rate of return, then we have expected market return on investment, then we have beta on share value. So by using these three terms, we calculate cost of equity as risk-free return plus beta multiplied by market rate minus risk-free rate, and that is your formula for calculating return on equity. Okay. Simple, this formula is going to be used for calculating return on equity. Understood till here? That this is how we calculate return on equity or cost of equity by using capital asset pricing model. Now, why we are using these two terms? Let's understand that. Cost of equity capital. What do we call a cost of capital? The expected return of our investors. So in this method, what we are using, okay, what will my equity investors expect from me in return? First of all, they will expect the minimum market return that they can get at risk free investment. For example, if a shareholder can invest 100 in two options, first option is in a risk free investment where their market value will be safe, the minimum return they can get of 10%, or the other option is invest in our company, that is, let's say our company is ABC Limited, okay, or invest in ABC Limited where they will have to take some risk. So if they are leaving this option that is risk free and investing in our company, they will want something higher for the risk that they're taking, right? And that is called risk premium. First of all, they will want, okay, I'm taking more risk than if in risk free I'm getting 10% return, I am expecting at least 15% return from your company. So that is their expected return, 15%, and risk free return is 10%. And the difference between these two is called risk premium, the extra return that investor is expecting for the risk that they're taking, that is 5% risk premium. This is your risk premium, okay? Plus, when we invest in equity share of the company, first risk we are taking is the profit may not be stable, right? So for that we are asking risk premium. Another risk we are also taking, and that is on the value of the share, because we know that share are invested in share market and their value fluctuates very much. If today I'm investing in a share at 100, it is possible that tomorrow that same share's value will be either 120 or maybe 80. So that fluctuation risk I'm also taking, right? I have to get return for that fluctuation risk also. And that fluctuation factor is given to us in the beta. What is beta? It simply shows if anything changes in the market. If let's say market goes up, how much share value will fluctuate, and that beta is the factor, okay? So we have taken this factor, so we have taken all the risk factor for an investor. First, risk premium plus the beta on the fluctuation of market, and we can simply calculate cost of equity. So this is your formula. It is very simple formula to use, easy to remember, risk-free return plus beta into risk premium. But I hope you have also understood the logic of this formula. Now let's move to the second model. So we have example also here. In case the risk-free return is 12% per annum and expected portfolio is 16% and the beta has 1.5. What does 1.5 beta means? If the market reduce by 10 point, okay, the company's share will reduce by 1.5, means it will reduce by 15 point. So that is the beta of the value, and I need to get return on this beta risk I'm also taking, right? So this 18% is the cost of equity. Then next method is, so are we clear on this cost capital asset pricing model? Let's take a pause for some seconds and then we will start bond yield plus risk premium approach. Till then you can look at this formula and note it down if you want. So the next method of calculating cost of equity is bond yield plus risk premium approach. Now, what does this method of calculating cost of equity mean? Investor simply says that, okay, I am investing in a long-term bond that is a least riskiest option for me, and I am getting 10% return for that. Now you want me to put this capital in your equity and take more risk, then what I need in return is this 10% minimum I was getting on the long term bond, plus just give me the risk premium on investment in your equity. And that is simply the cost of equity. Clear? So, an equity risk premium is added to the yield on long term bond of the firm. Example, if the yield on long term bond of the firm was 12% per annum and the equity risk premium is 4%, then what will be the required rate of return? Simply, this was the minimum return he was getting, plus they want 4% more for equity investment. They will want 16% in return, and that is nothing but my cost of capital. What is required rate of return for investor is the cost of capital for the company. Okay. Now, next model of calculating cost of equity is dividend growth model approach. Now, this dividend growth model approach is a very important formula. This is a concept that is used in so many finance concepts, so many financial management concepts. So, I urge you all to please carefully listen to this. Okay. So, even if you want to take a break, pause for a while, then come back and understand this topic because it is very important. So, what is dividend growth model approach? Let's just go to our notes. Then third method for calculating cost of equity is dividend growth model approach. This model is based on some assumptions. Let me tell you first. First is that we know return on a investment in equity shares is always the dividends. And we also know that this dividend is dependent on the profit a company is making. So, is it safe to say that if the profit or of the company are going to grow in future year, my dividend will also grow in the same way in future years? Yes, the company grows and my dividend also grows. Correct? So, we'll say that okay, currently I am getting dividend of 10 rupees on a particular share. So how does dividend work? If a share has 100 rupees fair value and we say the company is paying 10% dividend, so we are getting 10 rupees dividend in return. We take this dividend and we assume that this dividend will be received till perpetuity, means till the life of the equity share, till the period I have invested in this equity share, I will keep getting this 10% dividend in return. Okay, then we use a we use a time value of money concept, which says that whenever we have a perpetual annuity on a capital, on an investment, then return is calculated like this. So if I have 10 rupees, if I'm going to get 10 rupees every year on my 100 rupees investment, then I can say that this 10% is my cost of capital or my return on this capital. First, this is simple. This is one part of dividend growth model approach, that where we say this dividend we are going to get till perpetuity on this capital and this is my return. But this is the case when where we are saying that if I'm getting 10% dividend today, this dividend will continue, assuming that company is not growing at all. But in practical scenario, that is not the case. As the business of company grows, the dividend also grows. So in this formula, we take one more factor in consideration, and that factor is called growth. that how much are we expecting the company to grow in the coming years, and that growth percentage will also be added to this formula, and that is your cost of equity capital. Okay, means if I'm getting 10%, 10 rupees dividend on 100 rupees share, and the company is expected to grow at, let's say, 2% per annum forever. I'm assuming that the company will keep growing 2% every year. So my cost of equity is 10% plus 2%, and that is 12%. This is your cost of equity. Are we clear on that? I have done nothing. I did not ask you to learn any formula. I'm just explaining to you core concept, and that concept is just written in form of formula. If you remember the concept I'm teaching you, you will never need to learn any formula in this subject. I can guarantee that. So let's read this model. It assumes that current market price of firm's equity is equal to present value of all dividend expected to be paid by the firm in future, discounted at required rate of return. So the simple formula is dividend that we got for first year, 10%. The company has present value of share at 10% of 10 rupees, and the equity share of firm is trading at 100 rupees in the market. Dividend expected is 10%. The expected growth of dividend is 4% every year. So what will be the required rate of return? Nothing but 10 rupees on this 100 investment that I'm doing, that is 10%, plus 4% growth I'm expecting every year. I will add this 4%, and this 14% is my cost of equity. Are we clear? It is as simple as that. Next model we have earning price ratio approach. So in this case, we are using the same concept, but the numerator, the return numerator we are taking is a little different. I just showed you one profit and loss statement. This. Look at this P&L income statement and tell me one thing, that this 10,000 available for equity shareholders, this is their whole income. Now out of this 10,000, company can decide that it is going to pay you 1,000 of dividend and retain 9,000, or the company can decide any amount of dividend to pay and keep the rest of the income. But tell me one thing, both these component are whose rightfully? Who has the right on these profit? Answer is shareholders, right? So I can simply say that for this year, the return or the income earned by shareholders is 10,000. Answer is yes. Even though the company is paying them 1,000 for now, but they have earned 10,000, and this is their money only that the company is keeping. So that same concept is used in earning per share concept of calculating cost of equity. In dividend growth model, we were saying that the shareholders return is only the dividend portion that they are getting, but in earning per share, we are saying whatever the company has earned for shareholders, we need to calculate cost of equity on that. So our mod, sorry, we have earning price ratio approach, where EPS for the next year, whatever the company will earn per share divided by price, market price, the denominator will always remain the same, market value of share, and that will be your required rate of return or cost of capital. So how do we calculate earning per share? In this case, we had 10,000 rupees profit for shareholders, right? Now let's just say the company has 100 shareholders. So Earning per company has issued 100 shares, so earning per share is 100 rupees. This is your formula for calculating a earning per share. I'm also teaching you how to calculate these figures, EPS, and you just need to learn this balance, this PNL, and in that also you need to learn nothing. You need to learn just logic of how things work. So EPS divided by market value into 100. So if present value of market share of a equity share is 100 and expected EPS is 15, the cost of equity is 15%. Simple. And that is your whole concept on cost of equity. So we have completed cost of debt, cost of preference, and cost of equity. I hope that everything is clear to you till now. Next concept that we are going to see here is calculation of weighted average cost of capital. That how do we calculate overall capital cost of the company? Okay. Let's take an example of a company, ABC Limited. And ABC Limited has two this capital structure. Okay, they have 1000 equity shares of 10 each. It means they have 10,000 in equity capital, and they have taken debt loan. I'm taking simple loan example. So I've taken long-term loan, long-term debt of rupees 5,000 at 10% per annum. This is the case. Now, I'm asking you to calculate overall cost of capital. I've taught you how to calculate equity capital. I've taught you how to calculate debt capital. Now I need to calculate the total cost of capital. Cost combined of these two capital sources or all the capital sources. Okay, we need to calculate this. So what we'll need to do, first of all, we will calculate the individual capital cost. Means first cost of debt, how much it is, simply 10% because it is our long-term debt. We know that in long-term debt we take the interest rate as capital. Second, cost of equity. So let's assume that the company pays dividend at, in last year company paid 10 rupees as dividend and they are expecting to grow at 5% per year. So my cost of equity under dividend growth model will be 10 divided by market value of share. Also let's assume market value of share as 100. So 100 plus growth 5, it is 15% cost of equity. Simple so far, nothing complicated. Now we need to calculate weighted average cost of capital. So for that I need to make a table that will say this is my equity capital and this is my debt capital. How much equity the company has? 1000 shares, market value of 100 each. So equity is 1 lakh, right? And debt is of rupees 5,000. So this is my total capital 105,000. I will calculate weight of this capital or the ratio of this capital. It means simply 1 lakh divided by 1.05 lakh. So this is 1 divided 1.05, 0.95 and 5 divided by 1. That is your 0.05 approximately I'm taking roughly. Okay. So this is the weightage, and total weightage comes out to be 1, right? This is how my capital is structured. 0.95 is the weightage of equity and 0.05 is the weightage of debt. So the overall cost of capital will look like this. My equity cost me 15% and my debt cost me 10%. But in total capital, weightage of equity is 0.95 and the weightage of debt is 0.05. So 0.95 into 15, 14.25 plus 10 into 0.05 is 0.5. So my overall cost of capital in this company is 14.75%. Understood? This is your weighted average cost of capital. Cost of capital means overall cost of capital. And why did we say weighted average? Because the cost we are calculating by taking the weights of each capital source and then calculating the total capital. Are we clear on this topic? So this is how we calculate weighted average cost of capital. When cost of each component of capital is estimated, WACC is arrived by multiplying the proportion of each component with its cost and adding them. Equity capital is 40%, preference is 10%, debt is 50%. So cost of each is equity. They have given 20% cost of equity, preference 15, and debt capital at 10. So simply weighted average is ratio is 0.4, 0.1 and 0.5. So simply they have done 20% into 0.4. This is cost of equity. 15 cost of what is 15? Yeah, this cost of preference. 15 into 10%, that is preference share cost. Then 10% debt capital into 0.5 its weightage, and the total comes out to be 14.5, that is overall cost of capital. Clear on that? So this is how we calculate overall cost of capital. Next part is factor affecting the weighted average cost of capital. So how will the weighted average cost get affected? First of all, the weights on define the overall cost, capital structure policy of the company, then capital investment policy, how much dividend you pay, that also defines the cost. And there are some external factors also, like prevailing interest rate in the market, risk perception, risk premium, like in CAPM that cost increases, right? Rate of corporate and personal taxes, tax rate also increase the cost. So these are the factors that affect weighted average cost of capital. Next part we have weighted marginal cost of capital. What is weighted marginal cost of capital? We just now understood weighted average cost of capital, that shows the cost of total capital that we have right now in our company. Now, after this total capital, if I take another capital source, the cost for taking additional unit of capital will be my weighted marginal cost of capital. So in this case, if the company currently has 10 lakh rupees in its capital and it wants to raise 1 lakh rupees, so weighted average cost of capital will be the cost of this whole 11 lakh, right? But weighted marginal cost of capital is the additional cost of this getting this 1 lakh only, and this may be higher than the current cost. Why? Because if a company already has taken debt of 50% and if they are taking 1 lakh more debt, it means their debt ratio is increasing and their risk is also increasing for creditors, so they will charge more interest on that, and that's why marginal cost of capital will be higher than the current cost. So the rate of return required by investor tend to increase as more capital is raised by the firm. This concept is called marginal cost of capital. Example, cost of debt may remain at 10% if the amount of debt in capital structure is 100%, 100 lakh. But if the company raises debt more than 100 lakh, then the lenders will want 11% return instead of 10%. So that's how your cost of marginal capital work. marginal cost of capital work. Got it? Now, next topic we have optimal capital structure. So, what is the perfect capital structure? The one such mix of debt and equity in which the company is getting the minimum cost of capital. That is your optimal capital structure. And how do we design this capital structure? That topic is pending. So, let's just quickly go through that. This was approaches on capital structuring. So the first one is a net income approach. In this approach, we're assuming that cost of debt and cost of equity will remain the same irrespective of debt and equity proportion the company is using. Even though we just studied that when we change the proportion, the marginal cost of capital may increase. But if we assume that the debt and equity costs are going to remain same, then what we will use, as the cost of debt is lower than cost of equity, the overall cost of capital can be decreased through higher debt and increasing value. So in this case, if the company has a capital structure in which it has 50% debt and 50% equity, cost of debt is 10%, cost of equity is 16%. So its weighted average cost of capital will be simply cost of debt multiplied by weight, cost of equity multiplied by weight, 13%. In this case, debt is costing 10%, equity is costing 16%, means debt is cheaper. So we will want to increase our debt proportion to reduce the cost. So we increase debt from 50 to 60, and our cost of capital became 10 into 0.6 plus 16 into 0.4. Weightage of equity reduced, right? So now we have 12.4% cost of capital. So in this way, we can see that if the cost of debt and capital remain the same irrespective of the proportion, then we will choose the such proportion of capital structure in which we are getting least WACC. Okay. So this is the first method, net income approach, in which capital structure will be the one where we are getting lowest cost of capital. Next is net operating income approach. So this method assumes that WACC remains unaffected by change of debt proportion in the capital structure. So they're saying that if you increase debt, the WACC will not change. Market value is dependent on operating income and business risk of the firm. Both these risks are not impacted by financial leverage. Change in proportion of debt and equity does not make any change in value of the firm. ABC Limited cost structure is comprising 50% debt. So same example, that the company has 50% debt and 50% equity. Cost of debt is 10% and weighted average cost of capital is 13%. Now, they have given us 50% debt and 50% equity. Cost of debt is given, overall cost of capital is given. They are asking us to calculate cost of equity. How much will be the cost of equity in this case? So we can calculate this by using WACC formula, right? So what is our WACC formula? Uh, Cost of equity into equity proportion, right? Plus cost of debt into debt proportion is equal to WACC. So they have given WACC as 13% already. So 13% is equal to cost of equity I need to find, but I know the proportion is 0.5 plus cost of debt is 10% and proportion is 0.5. So I can say 0.5x plus 10 into 0.5 will be 5. So I will now to calculate cost of equity, we can solve this equation. 13 minus 5 divided by 0.5 0.5. So we get 8 divided 0.5 is equal to, so simply I can calculate my cost of equity by using this formula. So what does this formula tell me? That if I know my weighted average cost of capital, the company decided that I am going to keep my overall cost at 13%, and I know this is the cost of my debt, and whatever the proportion of debt I use, my cost of debt is going to remain the same. So out I have two components out of the three. Now I can see how much dividend I need to issue to keep my overall cost at 13%, and from this we can calculate our cost of equity, and we can also design our capital structure. Okay, now let's just say this is 16% equity, but in this case, let's assume I cannot assume to keep the cost of equity at 16% in my firm. What will I do? I know that cost of debt is going to remain same. I will increase debt component structure. What will that do? That will reduce my cost of equity. So this is how we design the capital structure, by using these formulas. Then the last one, we have traditional position approach. So according to this approach, when proportion of debt capital increases in capital structure, cost of debt will start increasing, because this is what normally happen when we start taking more debt. Debt became expensive because creditor will be worrying of the higher risk due to enhanced leverage. So assumption is cost of equity capital also increases with increasing leverage. It means constant it remains constant up to a certain level of leverage, gradually increases thereafter and beyond a point. So traditional position shows what, when the proportion of debt increases, both cost of debt and cost of equity will start to increase. So what will be our capital structure? The point at which cost of debt and cost of equity remains constant, right? If they start increase, we know that okay, this is the least point at which we need to maintain. Example is 2 to 3 is the ratio at which my cost of debt and equity is constant. If I increase it a little bit more, then the cost will increase. So I will ensure that my capital structure remain this only. So this is another method of designing capital structure. Last is taxation and capital structure. So whenever we are deciding firm's capital structure, we also need to take tax into consideration. Why? Because we get tax reduction on we get deduction on interest expense, and it reduces our tax expense. EBIT of a firm will not be affected by capital structure of the firm. So this is the example that we have, that a company has capital of 2 lakh, earning before interest of 1 lakh, and taxes of 25%. Cost of debt is same. Now under three different structure, we have to we have to find the cost of equity of the company, or the total profit. So first one is EBIT, where 1 lakh, we have 1 lakh EBIT in all cases, right? Debt of 2 lakh. First case we have 100% debt. Second case we have 50% debt. Third case we have 0% debt. Equity capital will be similar. We can calculate the interest cost, because interest is at 12% per annum. So 2 lakh into 12% is 24,000 interest. I'm getting profit before tax as 76,000. Then subtract 19,000 tax. I get 57,000 profit after tax that is available for equity, right? Total income on both debt and equity capital. So total income is 57 plus 24, that is 81,000 I have total earned, right? In scenario B, I am paying 12,000 interest, then my tax is 22,000, because profit before tax is higher, and profit after tax is 66,000, and I'm getting 78,000 of net profit. In third case, where debt is 0, my tax expense is highest, and profit after tax is 75,000, and I'm getting total return in 75,000. So we can clearly see that when we are using 100% debt, our profit available is higher. So that is another factor that can help us in designing the capital structure, and this is your tax expense. So these were all the factors that are going to help you in designing the capital structure. That was it on today's lecture. I will see you in other lectures just like this. I hope you were able to understand it in a perfect manner. Now you can practice some of the questions and you will get confidence on this topic. Please let me know in the comments how was the lecture, and if you have any questions you can ask me. Thank you so much. Bye bye.